it. So please welcome Gaurav Didwania to the stage. Please welcome with a huge round of applause. Beyond the hype, why earnings are the real alpha.
Good morning, everyone. Thank you, for having me here. I'm going to be talking about, how the markets work in general, and I see there's a mixed audience today, so I would not keep it build long-term wealth in the stock market. So a lot of people use different methods. Someone could be using technical indicators, some use moving averages, some use momentum. Some end up using factor investing, and a lot of things end up working. But the question is, how do you keep compounding this wealth over the next 10 years, 20 years, 50 years? How do you keep doing that? The answer lies mainly in how, the stock market works, and largely it, follows the earnings or the profits that the stock, keeps making. So we're going to be talking a little more about that. How do you identify these companies? How do you end up, tracking them? What are the common mistakes that people make, that can be avoided and should be avoided going forward? So before that, talking about Nifty, if you look at the last 25 years, or if you even look at, further than that, if you look at any other index, the Nifty has moved at 12% year on year for the last 25 years. And even if you go back, period, you'll be able to see that. And guess what? The earnings that they have given, which means, how much profit is a company making, all the constituents of Nifty, that has also grown 12% year on year. So what ends up happening is, there could be some times when the market is doing really well, there are some times that the market could be doing bad. All this happens over a short-term period, maybe 1 or 2 years. But over a long term, you can assume that this is going to keep happening. It's going to keep following the earnings. If the companies don't make profit, you will see that the Nifty will not move up over a longer period of time. And that has happened in the past. Let's say if you look at the global financial crisis, or if you look at COVID, the market had fallen significantly. What followed after that, or, also the expectation of the earnings, they had fallen over time. And, after that, the stock price had fell as well. But after that, there was a recovery. After that, the earnings recovered, and, post that, the Nifty recovered as well. So everything largely follows, the earnings, whether it's Nifty or any other small cap index, any other, strategy index, everything ends up following the base or the core that's the earnings. We're moving further, so talking about the different multiples, that Nifty had been trading at historically, and the number of, let's say, IPOs that have happened, in the country over the last, decade, or let's say last 5 years, you'll see that there have been times when the IPO market, there's been a boom in the IPO markets. A lot of companies are looking to list and, maybe raise more money from the markets to fund their business, or maybe looking for an exit. To do that. So there have been times, let's say if we pick out, interestingly, 2021, when the markets were trading at really high valuations. At that time, the market was recovering from COVID. Earnings had still not gotten back to the times, that it was trading at pre-COVID levels. But the multiples at that point were the highest. At that point in time, there was a concept, the India's digital decade, story, a lot of tech-driven businesses which ended up surviving as well during the COVID crash. The expectation that these will end up doing really well over time. And these companies were private earlier, funded by private investors, got listed on the market, raised money from the markets at very high valuations. Some of them were loss-making, some of them were showing very little profits. And the expectation that was that these are the companies of the future. But let's take some examples. Let's say Zomato got listed in 2021. It was down 60% from the listing price, and it only started going up post it starting posting profits. Before that, it was not posting any profits, and the stock market priced it accordingly, and the price kept falling after that, went down as close to 60%. Then there was Paytm. Paytm from the peak, it went down close to 75%. That was even higher than Zomato, and it's still not at the listing level. When I say listing level, not at the same price at which it listed. It's still not posting any profits. There have been, management guidance that, they'll keep posting profits in the upcoming quarters, but that has not happened. So markets end up, I would say, making sure that they price the underlying accordingly, and because of that, the price has still not reached what it listed at. Then let's talk about Nykaa. Nykaa is down was 70% down, still not at listing level right now. Must have gone up, slightly, in the last few months, but still not at the listing level. And again, you'll see that the profit is minimal. So what is happening over here? These companies, are they sound businesses? Some of them are. Some of them I think it's questionable, but are they valued correctly? Can an investor make money? It's possible that the products are selling well. It's possible that the company is seeing growth in revenue. But if you don't show profits, it's very hard for the shareholder to make money. Now, if you compare this to, let's say, some other businesses that were profitable, it might not have been the next big hype, or it might not have been the story that everyone was chasing, but they've ended up doing really well in the stock market. So I'll take some names. For example, Page Industries was up 30-40% in the same period where I spoke about Nykaa, Zomato, and Paytm, when they were down almost 50, 60, 70%. It was up 30-40%. The profits were up as well. Trent was up 2x within that same period. DMart, though the price stayed the same, the multiple had halved. It was trading at roughly 200 times multiple. It came back down to 100 times multiple, but the price still stayed the same. Though it was trading at a higher multiple, that's still a story, why you shouldn't be investing in a high sort of a business. But I mean, if you still post consistent profits, you are at least expected to, not lose money in the markets. Now, another example, around this that is personal to me. So I remember when the Facebook IPO came out back in 2012, the IPO came out at roughly 100 times earnings. And I was an analyst back then, and the idea was, I wasn't very bullish on the business, and I thought it was overvalued at that point in time. It had about 1 billion of profit, and about a valuation of 100 billion. So 100 times multiple, right? And I thought that this was crazy valued at that point in time. But fast forward to today, the stock price has gone up 20x. The earnings have gone up roughly 60x. That means the multiple has come down from 100x to about 30x. So that is still a story that companies that are valued at a very high multiple can still make money, but how many of these stories will end up really working? That didn't end up working for, let's say, some of the companies that are listed in India today. But if you show an earnings growth or a market capture like Facebook did back in the day, you can surely make some money. And that gets priced into a lot of companies today when, if you talk about the digital space, the tech space, consumer tech, you'll see a lot of these. In fact, recently, an IPO has been really hyped up, which is for Lenskart. And, that's what people have been talking about. It's at roughly 200 times earnings, and does it make sense for people to do it? Now, this is not a buy or sell or, hold recommendation, but things to think about before you end up investing in a particular company. Right. So what are returns really made of? So if you look at the stock price or the stock returns, it can be broken up into three things. The first one is the profit growth that the company can end up achieving. Second is the P multiple, at which multiple it trades at. It's possible you buy something at a 20x multiple and it ends up going to 40x multiple. So you've doubled your money there. But if the earnings have doubled too, then basically your money has quadrupled, because 2x you ended up getting from price growth and 2x you ended up getting from the P re-rating. What's additional to this is the dividends that you get from the companies. There are times when companies give out additional profits that they're making, something that they don't need within the business to grow. They keep giving it out as dividend. That is actual value for shareholders as well. So these are generally limited. You can assume a company could pay maybe 2%, 3%, maybe up to 4-5% as dividend in terms of yield. But large portion of the gain that you end up getting on a company ends up being from the profit growth, and in some shorter periods it ends up being from the PE multiple as well. As they say, the multiples expand over a year, but earnings expand over a decade. If you're looking for a company that can give you 100x could give you a 50x over the next 10 years, 15 years, 20 years. Your key driver to that is going to be the earnings. I'll give you some examples of companies that have grown in similar fashion. If you look at HDFC Bank, 20% EPS growth for 25 years and 21% is the stock return over the same period. So it's possible that, in a COVID crash or, the global financial crisis, the stock price had fallen considerably, but, it bounced back after the earnings kept going up. Page Industries, for example, it's given a 100x return since 2007, which is roughly 17 years before. Now, Paytm, if you look at, it's largely valuation driven, might not be posting, profits. It might have gone up. Some people sitting here must have made money on the stock as well over the last year or so. But the question is this repeatable? Can the company survive or, keep making a loss in the future, or would turn and, turn around and give a profit? Now, if you compare this to Amazon, for the longest period of time, like, the question that comes around is, now Amazon had not posted, profit, or had not posted significant profit for them to be valued at that level. But what was happening with Amazon is it was generating a lot of cash. It had negative working capital cycle, and the suppliers, they had to pay later, but the customers would end up paying them before. So though they might not have been posting profits, or must have been posting lesser profits on their books, the cash flow was significant. So the market was valuing it on cash flows. And when I say earnings, it does imply the cash growth of that particular company as well. So if you can assume that if the profit is growing, but if the cash flow is not growing, your company will not grow. But both have to grow at some point in time for the company to really compound. Some other notable names that I can talk about is Asian Paints. Grew EPS every year since '93, and the stock has been up roughly about 250 times. PI Industries, very few people would be knowing about this stock, or must have been the talk of the town at some point in time, but nobody has been talking about this, and silently it has given roughly 100x in close to 15 years. Nestle India, has grown 40x in 20 years. And the common theme about all these companies that I'm talking about that have grown at that pace is the earnings have grown at a similar pace. Trent has grown roughly 100x in 15 years as well. So as I said earlier, multiples expand for a year, but earnings expand for a decade. Now, how does Code really look at this? What is our thought process when we know all of this background? How do we apply it on a day-to-day basis? So there are 3 C's of compounding, as we call it. The first one is consistency. Now, any company that you look at, what are the chances that they'll keep consistently posting profits, or how predictable are their revenues, and how predictable is their profit? That's step number 1. It's possible that you meet a particular company, let's say they are targeting about 2x revenue, or let's say 50% growth in revenue for next year. But the chances of that, depend a lot on market condition, depend a lot on, let's say, consumer behavior. It depends on external factors. It's possible that, chances of achieving that is lesser. But let's say there's another company that is, targeting 20 to 25% growth over the next 2 to 3 years, and that is more, companies more confident of achieving that. What we end up doing is, selecting these companies that have the chance of consistently compounding over time. So that is, consistency for us. The second one is conviction, where predictable growth matters more than flashy revenue growth. Now, there have been times, in fact, we invested in a company that within a year gave us close to 10x return, but between that, there were 2 or 3 corrections where it had fallen more than 15-20%. Now, if you don't hold the stocks when it's falling, you'll never be able to see a 10x, 20x growth in those stocks. And the third is curation, where we hold fewer businesses but better businesses. The idea is not to hold, let's say, 80 to 100 businesses. Even if a stock doubles, triples, or grows 10x, your portfolio will still not grow by that much. But if you hold fewer businesses which are well researched, you're following a particular model, you know in and out about the company, the industry, or about the thought process, why you're selecting these stocks, because of could be a quant model as well. If you're holding, let's say, 10 to 20 to 30 stocks, which are very well researched, that would make a better portfolio. You can predict the earnings better for these companies. You'll be able to see them through, see them during the times, even when it's falling. You'll be able to hold them, in the journey for it to become, let's say, 10 to 20x. So yeah, I think that's been my time. If anyone has any question, I'll be happy to answer. I think I have a couple more minutes left. Happy to answer any question anyone has.
No questions? No one's taking notes? Any questions?
Maybe I answered everything in my.
Wow, exactly. So everyone, please welcome me in inviting. Please.
Can you emphasize more on the cash flow statement you made about Amazon? Like, how does it work if you can explain a bit?
Absolutely. See, we as analysts, we end up looking at the income statement a lot, which is how much were the sales, how much was the EBITDA, how much is the net profit. But the real, I would say the gain for a particular company is cash flow. A lot of times what happens is your net profit could be showing green, but maybe your capital is stuck in working capital, or there could be other expenses that could be a part, and maybe you're not receiving the cash on time. Maybe your clients or customers are not paying you on time. What happens with these companies is, though net profits are high, the cash flow is not high. So it leads to the company at some point going into a cash crunch, or might not be able to pay their vendors on time, or maybe able to pay their employees on time. So such companies, even though on paper looks profitable, might not survive in the long term. What was happening with Amazon particularly is they had negative working capital cycle. So what happens in, let's say, a retail business is, let's say if you're making a purchase online, you end up paying them immediately. So the money goes to them, but they have to pay their vendors maybe in 30 days or 60 days or 90 days. So they end up holding that cash for that much period. So on books, if you show lesser profitability, that could still work out for them. If it's a growing business, they end up getting more cash from the market itself, which they can use for their growth purposes. So such businesses, difficult to identify such businesses. But let's say today, if you think of any online business, it's a negative working capital business. There could be other challenges in such businesses, but this is a plus point, that a negative working capital ends up helping the business to grow. Perfect. You can just tell me your question, I'll repeat it.
Hello.
How does Code have that 1 decade long vision to spot these companies that you just mentioned, like HDFC, Asian Paints, and all of that? And how can retail investors also have that kind of vision? You mentioned the 3 Cs of compounding, but today, as of now, we have so many tools. We have Screener, we have all these sort of tools to find out these companies, but sticking with them for 10 years, and suppose in between the company goes bankrupt or something like that. What is your framework?
No, I think excellent question. The names in hindsight obviously look like, hey, you know what, these have already grown, so it's easy to pick these names. But largely what we try and do is, when we're actively trying to pick stocks, we want to be investing in something that, say, 5 years, 10 years later would have been really obvious. Now I can give you an example. We were recently, it's been a couple of years, we've been studying, let's say, the solar, industry. Now it's extremely obvious today that solar is going to do well. But let's say 10 years back, what was the mindset? 10 years back, if you had that vision that we're going to need this much electricity, and at that point in time, everyone's going to be moving towards clean fuel and would want to be having presence over there. I would say, let's say in solar, about 10 years back, we were at roughly 4 gigawatt capacity. Today we are at 100 gigawatts. So it's grown roughly 20-25x since then. Whereas the other ones, other sources of fuel, they've not even grown 2x. So that is a thing that, let's say, today what we think about, what are the obvious things that could happen tomorrow. One thing is, let's say, digitalization of assets. That is something that we are extremely bullish on. We could be looking at, the idea is to pick these themes that you think that could make substantial impact in the future, and within that you have to target the companies, target the ones that you think have the best chance of success. Honestly, when we do it, we don't have 100% chance of success. In, I would say, fund managers' life, if you end up getting 65% right, you've achieved what most people haven't. So those are the odds that we end up playing with, and we hope that our winners give us, winners are in the range of 60 to 65%.
Yeah, I like the answer. Just to add on to that point, I read this quote that it depends on when you're right, how much money you make, and when you're wrong, how much money you lose. How much you lose has to be less, but when you're right, you're supposed to make a lot of money. So that was nice. Nice talking to you. Thank you.
Perfect. Thank you so much, guys, and I'll be sitting here, happy to talk to each one of you later in the day. Thank you so much.
Thank you.